In this presentation, we're going to look at impairment and the difference in treatment between GAAP and the international standard. We're going to look at the journal entries as they would appear based on the method used, the rules that apply, and then we'd look at the adjustments on the working papers. Okay, here are the ground rules. Under general accepted accounting principles, the carrying amount of an asset is first compared with the future cash flows, undiscounted, to be generated from the asset to determine if an impairment exists. If the future cash flows exceed carrying amount, the asset is not impaired under U.S. GAAP. However, under the international standard, an asset is impaired when its carrying amount exceeds its recoverable amount, which is the larger of net selling price and value in use, which is the discounted future cash flows. So in this case, we're using discounted future cash flows versus GAAP, which uses undiscounted. So now here is our example. Mike purchased an intangible asset with an indefinite life for 50,000 rupees, which means in this example, we're going to have to go from the international standard to GAAP. And we're going to assume we're not going to worry about currency conversions or taxes. In 2015, now, since it has an indefinite life, there is no amortization. In December 2017, the asset could be sold for 38,000 rupees with zero cost to the seller. The undiscounted expected cash flow from the continued use is 60,000 rupees, and the present value is 40,000 rupees. His company is owned by a U.S. company using GAAP, and therefore the balances must be converted from the international standard to GAAP for consolidated financials. So what we're going to do now is look at the journal entries under the international standard and GAAP, what they would look like on the books, and then we're going to prepare the entries on the conversion worksheet going from the international standard to GAAP for both years. All right, for 2017, the entries for the international standard and GAAP would be different because the rules are different. So the first thing we've got to do under the international standard is determine, we have an impairment loss? So we're going to take the cost and we're going to compare it against what we consider is the recoverable amount, which is the higher of the net selling price and the net present value of the future cash flows. So in this case, it would be 40,000 subtracted from the cost means we have an impairment loss of 10,000 under the international standard. Under GAAP, you compare the undiscounted cash flows, in this case 60,000 rupees, to the book value of 50,000 rupees. Since the future undiscounted cash flows exceed the carrying amount, the brand is not impaired under U.S. GAAP and no entry is required. So here are our journal entries for 2017. There would be no journal entry in 2018 because we would have already taken care of the impairment loss, so there would be no journal entries at all. So now we can go to the conversion worksheet. The conversion worksheet for 2017, we need to back out the impairment loss because we're going from the international standard to GAAP. And in 2018, we again need to back out that impairment loss, but this time it's going to go against retained earnings. So in 2017, to convert to GAAP, we're going to add back in to the intangible asset the 10,000 and back out the expense impairment loss. In 2018, again, we're going to reestablish the intangible asset, its original amount, but this time we're going to go against retained earnings since this is from a prior year. Now here is a summary of what that looks like. The effect on the income statement is, of course, we'd have an expense under IGAAP, but we'd have none under GAAP. So we have a difference of 10,000 in 2017, but nothing in 2018. That's why there would be no journal entries. Now on the balance sheet, we would see a difference in the carrying amount for the intangible asset for 2017 and 2018 of $10,000. That includes my presentation on what happens when you have an impairment of an intangible asset under GAAP and IGAAP.